Hello, everyone. Today on the Final Bar, I'm talking to Tony Dwyer from Canaccord Genuity. We'll talk about some of the big picture themes affecting the markets now. Sort of an interesting configuration to the S&P. The major averages opening higher, just trending lower through the course of the day. The S&P, the Nasdaq, really starting to lay into some of those key levels, with the S&P closing back below 4,400. What does this feel with the defensive sectors at the top of the list, energy at the bottom? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. It's Thursday, April 21st. Thank you so much for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit, using the power of stock charts to better understand investor behavior and market dynamics. A very interesting day today. Yesterday's choppiness feels like nothing compared to the directional move you had through the course of the day here. A familiar theme of the Dow at the top, the S&P in the middle, the Nasdaq at the bottom. But instead of there being sort of a barbell around the unchanged level, everything down today, right? With the Dow down 1%, the Nasdaq doubling that percent return to the downside, down over 2% today. A defensive feel again to the markets overall today. We'll look at the chart of the S&P 500 today, focusing a little bit on sentiment indicators. We'll look at the AAII Survey. It's interesting. You'll see it's actually a little less bearish, I guess, than last week. I bet if they'd asked people today, you'd probably see some increased bearishness than the numbers might suggest. We have a great guest today with Tony Dwyer. I'm excited to catch up with him here in a little bit. Coming up next week, Monday, Tuesday, Wednesday, we're actually taking off from our live broadcast. We're taking a trip down to the NAB show in Las Vegas to hopefully come back with some really cool software and hardware to upgrade the viewer experience on StockCharts TV. So on this show, we will be doing Trend Following 101 on Monday. We'll be breaking down breadth indicators on Tuesday, the 26th, on Wednesday, the 27th, digging into ratio analysis. We'll be back live on Thursday, the 28th, with Jeff Huge from JWH Investments. And then one of my mentors, Jeff Weiss, will be coming back on the show the week after, on May 3rd. Let's continue on today's show with our market recap. As I mentioned, yesterday, sort of a choppy day with the S&P netting out to essentially a zero for the day. Today, a very different feel, opening higher, closing lower. We're going to look at the charts of the S&P and the Nasdaq and break some of those down here in a minute. But just to check in on the end of the day returns on some of these different major indexes and asset classes. The S&P down about 1.5%, as I mentioned, closing back below 4,400 now. The Nasdaq down over 2%, the Nasdaq Composite around 13,170. Mid caps and small caps both down as well, and even more to the downside than the S&P. The VIX is actually bouncing back higher today. Yesterday was down around 20. Today, bouncing higher to around 23. Looking at some other asset classes very quickly, interest rates in general moving higher today with 10-year, 30-year yields increasing, both of them remaining below that key 3% level, but that's a level a lot of people have been focusing on it to see if that's achievable, which I think it certainly could be. Bond markets in terms of bond prices coming down, the dollar index up about 1/3% using the UUP ETF. Commodities overall sort of mixed, with gold and silver both down. Silver was the worst performer of our commonly followed ETFs, with the SLV down over 2%. Cryptocurrencies in general coming off, with Bitcoin, especially Ether, really rotating to the downside, along with the distribution in equities. You're seeing cryptocurrencies move lower as well. Let's check in on the daily chart of the S&P 500. There's a chart we review on most of the shows. My concern with this chart now, and I try not to just speculate. I think a lot of times when you're just learning technical analysis, it's very, very easy to do what I call wishful thinking analysis, which is starting to see patterns that may be emerging, even if they aren't already doing it. So I don't want to get too excited about a bearish, dramatic bearish call given the distribution today. Let's look at the overall trends and what levels are in play. A number of actual levels have been in play over the last month, but particularly today. The story for the last month has been coming off of the rally, which was mid-March to the end of March. The S&P finally got above 4,600, eclipsing the February highs at the end of March, but it was a stalled breakout, or what I'd call a failed breakout. The gap higher that propelled us above 4,600 on a closing basis has been the high watermark for the last 3 or 4 weeks, as the S&P came off pretty soon from those levels. Now we've gone back below the 200-day moving average, bouncing off of the 38.2% retracement level. And that's using the January high and the February low. 38.2% of the way back up is right around 43.80. That's where we found resistance in early March, late February. And so not surprising that we're now finding support around that same level, around 43.75, 43.80 over the last couple of weeks. Look how almost all of the days here in the last week and a half have been right at that level. The lows of each of most of those days have been right in that blue shaded area. And so as you continue to confirm a key level of support, the assumption in the technical analysis world is that you are further validating the importance of that level. The chart is showing you that buyers are coming in, or selling pressure is being alleviated, whatever is causing the price to bounce from that level. That's encouraging in the short term. The problem, though, is once that level stops holding, the implication is that all the buying that has allowed the market to bounce off of that level is now gone, right? The anecdotal last buyer has made their trade, and all of a sudden there's a vacuum below the current price action. I think breaking below 43.75, that would take us below the low over the last week. And I think you're looking at further downside targets from there. We've identified 4,300 as a level. I'd be looking more at 4,200. That's a big Fibonacci level if you look at the longer term chart over the last couple of years. And I think from a technical perspective, pretty reasonable. Also in the short term, worth noting that earlier today, we were above the 200-day moving average. We opened just below 4,500, traded higher, but at the close, we're actually getting back down below there. So a failed attempt to get back above the 200-day moving average. Well, earlier in the day, all of a sudden looked a little bit encouraged. Like, all right, we're starting to make some upside progress. I believe the course of the day tells you that it's more selling than buying in general, more distribution versus accumulation in the short term. And it's really starting to affect the action on the S&P and the NASDAQ. I did want to bring up a chart of the NASDAQ, by the way. Let's look to here, equity market indexes. Look at the NASDAQ composite. You know, we mentioned we actually had this chart featured as one of our 3 and 3 charts yesterday. We talked about this being a potential inverted head and shoulders. It's basically called a bottoming pattern. We have a big low surrounded by 2 higher lows. And my cautionary comment was you really can't call that a head and shoulders bottom until the neckline is broken, which means the NASDAQ would actually have to rally all the way to around 14,700 to complete that pattern, to validate it and indicate that a bottom was in place. Today, we actually bounced off of the 50-day moving average and made a new swing low for the last 4 weeks. So overall, not seeing the renewed strength you might want to see. If you're seeing this emerge as this big bullish bottoming pattern, today's certainly not helping that case. I think still, we can trade all the way up to that level. And I think this is still a chart in consolidation mode. We get above 14,700 and things could be a little more encouraging. Feels a pretty far way away given the distribution that we saw in today's session. Let's check in now with the sectors to finish off our market recap. As I mentioned in the introduction, a bit of a defensive feel overall with consumer staples, the best performer. Now, all 11 S&P sectors were down today, but the XLP was the best performer, pretty much unchanged for the day. REITs were number 2. And as I was scanning for new stocks making new highs and new lows for my premium members at Market Misbehavior, a lot of real estate came up, a lot of utilities came up, a lot of consumer staples. This is the sectors where you're finding a lot of names. Now, granted, there were names in other sectors like financials and industrials and healthcare. So it's not just in those defensive sectors, but when the defensive parts of the market are really working in general, that causes me to not be overly optimistic on conditions overall. At the bottom of the list, you have energy, giving back some of those previous gains. Energy has by far been the top performer year to date, down about 3%, followed by communication services, technology. So some of it's sort of a mishmash of things. Consumer discretionary was third from the top, with Tesla having a pretty good bounce with earnings this week. Just to finish off, looking at a couple charts, if we could, let's look at United Airlines because the airlines, a number of them reporting earnings this week. We have UAL yesterday, American Airlines earlier today. There's another one in there somewhere, if I remember right. But you've had a couple of them come out. UAL gapping higher today. Up almost 10% today, ended up being about 9.3%. What's interesting about a gap like this on earnings, and again, this happens, and that's one of the challenges at applying technical analysis to equities is about once a quarter. You usually have a big change in valuation when investors digest the most recent quarterly earnings and start to reevaluate where the stock is trading versus what it actually should be worth, given the fundamental stories and really the prospect of future growth for earnings going forward. What's interesting about UAL, and this is a great example of why I think charts can be so valuable around earnings. We've now gapped up right above the high from February, right above the high from January. So the highs for the year so far have been right around $50 a share for UAL. We've tested that a couple times on these failed attempts to get above the 200-day moving average. We failed at the 200-day again at the end of March, bounced off of it about a week ago. And then today with the gap higher, sort of completing that rotation above there. So in some ways, this is one of the easiest charts you'll see, because as long as we remain above that breakout level, this is a pretty compelling rotation with a higher low, now a higher high. And as long as we hold above previous resistance, now becoming support, could be a compelling opportunity. So 50 is an interesting level to pay attention to for UAL. Again, on the earnings today, gapping right above that level. American Airlines, same thing. Now this actually traded lower during the day, and this is what concerns me on the chart of American, on the chart of Tesla. Gapping higher on earnings, but trading lower through the course of the day. Tesla noticeably finished the day right around the 1,000 level. And we've talked many times on the show how those big round numbers often become pretty meaningful. Tesla's been toying around with the 1,000 point for about a week and a half now. The question is, which side takes control? Do we break support below 950, or we rotate higher above 1,100 and continue to push to the upside? Let's take a quick commercial break. We'll be back with Tony Dwyer from Canaccord Genuity. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the financial markets using the technical toolkit. We're going to have Tony Dwyer from Canaccord Genuity join us in a few moments. Beforehand, just a couple quick announcements. First off, we welcome your questions. We'll do a mailbag segment on Friday's show, end of this week. We'd love to feature your question live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have such fantastic guests, Tony Dwyer and many others with a lot of expertise. We just hosted our most recent episode of The Pitch earlier today, which will broadcast it a little later this evening. All of that is available for free on demand at StockChartsTV.com or on your mobile device. Just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Tony Dwyer. Tony's joining us from Canaccord Genuity in New York. Tony is a successful and accomplished pilot. So before these sort of appearances, I love to ask where he's flown recently. So thank you for inspiring us with your tales of aviation, but especially Tony, thanks for coming on and sharing some market thoughts with us today.
Of course, I'm really happy to be here, Dave. So the chart, what I want to talk to is some of the credit metrics that are out there and clear up any kind of miscommunications. I mean, one of my greatest strengths is I haven't died yet, so I'm old and I've been doing this for a while, right? Which means I have some experience of making mistakes that I've hopefully learned from. The chart that you have in front of you is currently the Bloomberg chart that's showing on the left scale. It's the implied policy rate of the Fed funds rate. So when you look at 12/14/22 on the bottom, that's by the December meeting, the market is now expecting over 2.5% on the Fed funds. They're expecting 10 rate hikes. So what that translates to, Dave, is there's 2 50 basis point rate hikes. So when people say on TV, like you or me, and they say the market's way ahead of the Fed has just raised rates 25 basis points. Yeah, the market's ahead of the Fed. What? Anyway, I digress. They've been talking hawkish. James Bullard's been talking potentially about a 75 basis point hike. That hasn't happened since 1994, and I'll get to that in a minute. But this is truly an extraordinary environment because the market's where you see it is. And if you kick to the next slide, Dave, this is where the Fed is.
Yeah.
The Fed funds rate on the bottom, you can't even see the 25 basis point uptick. And the purpose of that is you said it about the market. What is a lower high and a lower low? What does that define? A
That's a
downtrend.
downtrend.
And there is no change in that trend on this chart. So we hear a lot of times talking about a Fed that's super hawkish. They've not even come close to raising rates if you hit the next one. So what this distortion of where the market has moved so much faster than the Fed has done, it's created a big divergence in the various yield curves. So in a normal market environment, people, myself included last time, focus on the 210 yield curve. And that's because the banks are getting their money by going to the market. So they got to pay market rates. Let's use a 2-year rate. And then where they're lending it at, let's call that 10 years. We forget why you use the yield curve. It's the difference between where a bank gets their money at and where they lend it at. So if you have an inversion of the yield curve, a bank is not going to lend the money. So that's the 210 curve. The curve on the bottom is more appropriate this cycle, which is the 3-month and 5-year, which has been steepening. And why is that? Because the Fed is still near zero. If you go to the next slide, what's been unique to this cycle, Dave, and the reason that I'm using the 3-month to 5-year, it's not just because I typically am bullish, which, I've been looking for a tumultuous year like 94, which I'm going to show in a second. But when you look at this chart, there was $4.75 trillion put into commercial bank deposits. Trillion. So if the banks are raising 20 to 50 billion in the credit market that is driven by the 210 curve, yeah, you use that one. But there's almost 5 trillion put into the deposit rate that's still near zero. So when the 5-year note yield goes up, if you go to the next one, when the 5-year, next one, other way. There you go. So that the blue line is the 210 curve, which is almost inverting, which people like me is saying it's a recession. The black line is the more appropriate one, given that the bank deposit rates are still so low. When the 5-year goes up in yield and you're still near zero in what you're paying for it, you have further incentive to lend. Banks are dying to lend money right now, especially at the higher rate. You go into a recession when you have a significant and sustainable shutdown of money availability. It's not happening. It's not happening because of that yield curve. And the only other time, Dave, that I can find the spread like that to be so negative is, you guessed it, 1994, when Alan Greenspan spooked the markets. You remember this well, in February of 1994. And for the viewers, the last time that, according to the Bloomberg Total Return Index, that the bond market performance for U.S. Treasuries was as bad as this March, the only other time it was worse was February of 1994. So what that created was our playbook for this year. The first half is tumultuous. You're freaked out by the Fed. Every time the Fed says something, the market does what it did today. It reverses course. It's tumultuous. But eventually you get oversold enough. You get through that first big Fed rate hike. It was a 50 basis point hike in May of 94. And then you get through that rate hike and you're like, okay, the market's discounting it. In middle of 94, by August, you rallied back to the high because your data was still good, like we're going to be now. And you think the Fed's discounted, then you start to get even more Fed rate hikes, and then you get the weak economic data. And here comes that stagflation. The Fed's going to drive us into worse. So you ended up retesting the low in December of 94. The whole thing added up to a big bag of nothing. 1994 was a flat year. That's what our call is for this year. So for the viewers, when you're down 8 to 10 or even more percent, and you're not in a recession, and you think it's going to be a flat year, that gives you some upside, right? So we're looking to buy into whooshes now. We're not quite there yet, and not chase ramps when you're pretty close to zero.
So given that, and it's interesting, a lot of people I think don't really respect what 1994 was like, or really haven't studied it enough. And this is a flat year among, an incredible run, bull market run for stocks in general. If that is the environment, if it is a choppy environment, how do you position yourself over the next couple months? Is it just to be in relatively safe portions, or is it places where you're seeing opportunistic moves? Because as a stock picker, I'm not struggling to find stocks that are breaking out, even if the market has been kind of choppy. How are you thinking opportunistically here over the next couple of months?
David, I'm a little bit nervous about the consensus trades when they become so pervasive. So if
Yeah.
you look at energy, materials, metals, they're ripping,
Yeah.
right? And that's I don't, I'm awful at chasing that kind of strength. Remember last April, like I was getting creamed because I was not chasing the FANG stocks
Yeah.
publicly,
Yeah.
right? And then, fast forward to today, thank God. I
Yeah.
missed some upside, but I don't like to chase that kind of those kind of rallies. And I
Yeah.
think that's developing in some of those names. So we're neutral sector wise. This has been a year for us to so far just stay out of the way.
Yeah.
I mean, I think the last time I was on your show, we talked about how every time the S&P in a calendar year since 1990 has been up 25%, you're down in the first part of the year by a median of 5+%.
Yeah.
Right.
Yeah.
So here we are. I'm not going to change, you want to make the market gods laugh, tell them your plan. I don't want to change what's working.
Yeah.
So I want to add to that those areas that have been hit the most when it gets oversold enough. And believe it or not, that would be infotech, that would be banks, that would be the absolute things that you totally don't want to buy.
When the time comes to buy, you won't want to, as Walter Deemer once told us.
Mm-hmm.
Listen, Tony, it's great to see you. Really appreciate you, as always, taking some complex stuff and making it seem super accessible and straightforward. Stay safe, fly safe, and we'll talk to you again soon.
Awesome. Thanks for having me, Dave.
That's Tony Dwyer. Tony's a strategist at Canaccord Genuity in New York, also runs Dwyer Strategy, does a great job. And what I've always appreciated about Tony's work is how he takes a lot of data that I don't get exposed to day to day, but then helps put it into proper context. That's what I've always valued about Tony and his work. I really appreciate his thoughts, given a lot of uncertainty about where how the Fed could impact the markets going forward. Let's continue on with our next segment, Getting Sentimental. We love to do midweek, usually on Thursday, is look at some of the sentiment data. A lot of the survey data is updated on Wednesday and Thursday. So Thursday is a good time to sort of take a look at a number of different things. We're going to start with the VIX. What's interesting about volatility using the VIX is, the volatility regime sort of changes. I always talk about volatility in the form of regimes. When people key in on key specific levels on the VIX, I always like to remind them, look, a particular level like 20 or 30 or 10 has relevance in a particular regime, but then things can totally shift. And that's the challenge of using something like the VIX as a trading tool, just on its absolute levels, because it can be very difficult to pin down. It's not, range bound. It doesn't have a clearly defined range. It can fluctuate quite a bit. What's happened though, if you look at this most recent data, look 2022 year to date, really starting in November, which is when the character of the market really started to change. There's a lot of breadth indicators, a lot of momentum indicators, some indexes actually, and a number of stocks actually topped out in November. If you look there, the VIX is sort of settled in with about a 30 to 35 level on the peak, and that's when the VIX has peaked. That's when bottoms have occurred in the S&P 500. On the downside, it's rarely gotten much below 20, particularly starting year to date. So in February, in late March, early April, we had some of those points. So if you look at that range from 20 on the lower end to around 30, 35 on the upper end, you have a pretty clear identification of the peaks and valleys in the S&P. Really, since November, it's lined up actually very, very well. So what's interesting right now is we are coming off a fairly low level on the VIX, hitting just below 20 at the end of March, now bouncing once again off of 20 this week. And the concern I would have in terms of a bullish read on stocks is as the VIX would move higher, which it's starting to do, certainly given today's session, really doesn't put a lot of opportunity for an upward move in stocks. The S&P and the VIX can move upwards together. That has happened on some timeframes, but overall, higher volatility, higher uncertainty, usually not a great sign for stocks. That's some of the pattern that I'm starting to see potentially with the VIX bouncing off of the upper teens around 20 here recently. Looking at survey data, last week we didn't have a live show on Thursday, but one of the biggest, most negative reads on the AAII survey going back in deep history. It is very rare that bears have outnumbered bulls by over 30%. That's actually the reading that we got last Thursday. So you had about 45% bears, only about 17% bulls last week, and that swing really lines up with a really beaten down sentiment reading. This week, a bit of a reversion back to the upside, with about 19% on the bullish side, 44% on the bearish side. What's interesting to me is if you look at, again, talking about how the markets changed in November from the market peak, or I guess by a number of stocks and indexes peaking in November. Look at how rarely bulls have outnumbered bears. This has been in general a pretty solid string of bearish sentiment. What's interesting is the market can actually bottom out, and the market can actually rally meaningfully with the sentiment remaining fairly negative. And a good example of that is mid-2020. The market actually bottomed out in March 2020, as we know. The net survey data, looking at the AAII survey, didn't actually turn positive until October. That was back, that was further on when the market was in that big consolidation phase, sort of a coil pattern there in September and October. November, December is when we finally broke to new highs again. That's finally when bulls finally were taking control. Bulls outnumbered bears. So the concern I have right now from a sentiment level is this is fairly negative sentiment. Is it so negative that it could be positive? Potentially. My concern is that the market certainly could continue lower. If you look, some of these really bombed out sentiment readings have not been at the bottom. They've actually been before the market can continue a little bit further to the downside. The name exposure index is the National Association of Active Investment Managers. Not a big change. For the last months, we've been rotating around 65 to 85%. Currently, we're right in the middle of that, around 74%. So overall, this is sort of the median value, the median observation on this data going back for many, many years. So no real clear signal. Above 100% would be overly bullish. Below 50% would be overly bearishly positioned. Right now, we're kind of right in the middle. So it's interesting. My guest today, Tony Dwyer, talked about being, essentially being out and waiting, sort of neutral and cautious and waiting to see what happens. And that's what I would say the name exposure index is sort of telling you here now. Average money managers taking an average exposure to equities and waiting to see which way this thing plays out. Finally, we'll talk about the put call ratios overall. You're seeing a bit of a spike in some of these. We'll look at the equity only put call ratios, one I usually like to look at. In gray in the background is the raw data. This is a daily reading, so it's pretty noisy. And I smooth it out with a 5-bar moving average, which is the purple line. You can see the spike in it. The average put call ratio over the last week really not moving a ton just yet. But if we continue to see elevated ratios in the put call ratio, you see that pop up. It'll tell you a little bit more negative positioning. That's what tends to happen when the market's coming off, and a peak in the put call ratio could line up with a market bottom. We are not there yet, which suggests we certainly could have further downside potential for stocks. That's our segment, Getting Sentimental. We need to wrap to today's show and go to the 3 in 3 charts in 3 minutes. Let's hit on some of the key themes we can review from a technical perspective. Chart number 1 is UAL. I mentioned earlier we were recording our latest episode of The Pitch, featuring 3 fantastic guest presenters. And one of the things we talked about was airlines. One of the stocks featured was Alaska Airlines, ALK by Jessica Inskip. And I encourage you to check that out at stockcharts.com/thepitch. But if you look at UAL, which is another airline reporting earnings this week, you can see the gap higher today. Not a bad move, up about 9%, now testing resistance right in this blue shaded area, which lines up with some of the previous peaks. The peak over the last 6 months is just higher, around $55. I'd like to see it get above there to really be encouraged, but an airline is overbought. So that's a sign of a real emerging strength there. You're seeing it elsewhere with Southwest and other names in the industry. Chart number 2 is Tesla. Tesla is one of those names today that had a nice earnings release, had a gap higher. So at 935, it's feeling pretty good, like we're going to start to see this nice move higher on earnings. Given back all of that and more through the course of the day, and Tesla actually closed back down right in the range that it was over the last week and a half. So even though good quarter, good gap higher, good move after earnings, we didn't go anywhere, right? We're right back in the range that we were yesterday. That is not how a bullish phase emerges. You want stocks beating earnings and then moving higher materially. Finally, we have emerging markets. We've really avoided talking a lot about non-US markets, just given the strength in the dollar. There's not a lot of inspiration for US-based investors to go outside the US. This is a great illustration of a chart in a downtrend. Energy looks like this inverted. Prices moving higher, moving averages sloping higher. In general, I like to avoid charts where it's the opposite, and that's where EM is finding itself. That's it for our show today. I want to thank Tony Dwyer from Canaccord Genuity joining us in New York, as always, giving us a great perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.